So I essentially, at dinner, first time meeting this person, I essentially made them a proposition. If I go ahead and buy this building, will you go into business with me? And that's essentially how it came about.
Wow. So you've closed on the building already. How
Yeah.
you buy cash, or
Yeah.
how do you raise enough cash to buy a building that's a dead asset?
It's my own cash for one.
As an operator, I know other investors are romanticizing multifamily investing, and I'm looking to learn from other investors' mistakes. I know you are too, and you found the right place. Welcome to Myers Methods Presents Multifamily Missteps.
Yeah.
Everybody, and welcome to Myers Methods Presents Multifamily Missteps. I'm your host, Jerome, and I've got the extreme pleasure of having Fabiola Fleuranvil with me today. How are things in Miami?
I mean, Miami is always great. It's Miami. You can't really go wrong being in Miami. So I think we might be at like 90-degree weather right now, but it's Miami.
Are the beaches back open yet?
No, it better not be. That's Jacksonville, not Miami. We're 4.5 hours away from that. So we got South Florida and then the rest of Florida. Yeah. So that's them up north.
Do me a favor and tell me how the listeners can get in touch with you if they want to learn more about you and your story.
Okay, well, I'm on IG at Invest with Fab. You can find me on IG and on Facebook as well, Invest with Fab. And then my company, Icon Heritage Partners, you can find me online, iconheritagepartners.com.
Perfect. So now let's talk about your background. Like, how did you get into this space and what type of stuff have you been working on?
Well, I bought my first investment property in 2006 as a young buck coming out of grad school in Atlanta, pre-market crash. And actually how I got started in real estate, the guy that I was dating at the time, like you said, I got fired. So I've always been an entrepreneur, always had, my own money machine. Even as a kid, I was that kid in the 7th grade that was making money selling chips and candy. Not that I needed it. But I like the idea of being able to make my own money. So I always knew that I would never go into corporate America. So even though I just came out of grad school with an MBA, I already knew that I was not going a corporate route. So I started my marketing agency. So I actually have 2 businesses, which I still do have. And then at that time, I also knew that I wanted to go into real estate. So the guy that I was dating was like, I don't know anything about investing, but I know you and I know you have hustle. So I'm coming out of grad school, starting a business. Obviously, you have no money because you're like, I'm not going the corporate route. So you have no money, you have no credit. So he essentially loaned me the down payment that I needed, and his boy had the credit. He loaned me his credit. I had the brains, I had the hustle. I was like, all right, so the 3 of us, we're going to go ahead and do this. So that was the very first investment property that I purchased. It was a rehab meant to be a fix and flip. And at that time, if anyone was in the game in 2005, 2006, that was the sweetest time to be in real estate. That's when everything under the sun was being created. Wraparound mortgages, lease options, every single scenario that you could think of was being done at that time. Obviously, that led to a lot of the fraud that we saw that led to the crash. But and me being young at that time, I came in towards the tail end. So we purchased this building. I purchased it. They gave me the money and the credit, and I paid them back within 30 days of having the first check from the property. Because it's a rehab. So I got a hard money loan on it. You're about to do a rehab. So I paid them from the rehab funds. And so I made them home in 30 days. And then once we completed the rehab, there was so much equity in the property, took some of the money out, paid them a split from that, and then took them out of the deal because at this point, I can do it on my own now. And then there was additional money that was left. So, on that one particular property, I made a couple of checks. And then I was able to do a couple more before the market crashed. And being young at that age, It's the first time that you're seeing a nice fat check walking into the bank and they're looking at you like your age does not match up to this. You feel good, right? But what I didn't know and what I didn't learn at a very young age which became my foundation for how I invest now. I'm going into it all wide open and optimistic because everybody's making money in real estate and I want to be the ones too. But market timing is one, understanding economic conditions and how all that plays into real estate is another one, and just money management, construction management, all of these things you don't know until you actually go into a deal and make those mistakes. You're going to learn it one way or another. And I learned it very early on. And then the market crashed. So you're forced to learn. So I only really had a good year and a half before the market crashed. So it was like I had a fast high and then it dropped really fast, so to get a really fast, training ground like that at a very young age, that did a lot for me because one, I was in my very early 20s. So I figured whatever I lost, by the time I'm 30, I could easily make it back up. So I wasn't afraid to lose anything at that point. I figured that, I would rebound anyway, versus had I been 35, and I experienced that, I would have been crushed. I don't know how I would have rebounded. So that's helped me from, what was that, like almost 20 years, 15 years ago? That's helped me, to really be the investor that I am now. I'm still, I have a higher risk tolerance, but I'm very prudent. The way I run my numbers, totally different. My no goal for deal analysis, totally different. And even how I manage contractors, totally different. Not that you're not going to experience any challenges, but that young 22, 23-year-old versus me now, totally different investor. So, where investors don't really like to share their hard stories, I experienced that from the gate.
Wow. Okay. So you stayed in the investing space and you transitioned from fix and flip to multifamily. So talk to me.
It took a while to transition into that. So after the market crash, obviously I tapped out like a lot of real estate investors. You had to rebound and, make up for some of the losses. So I had my other business. So that continued to be my fallback. And then when I jumped back in, I was still in in a single family space. I created an investment fund with a few other Black millennials, and we called it the Miami Millennial Investment Fund. At that time, it was to address gentrification. So this is well after we've, recovered as an economy. This is 2015 to 2016. So we essentially created this social impact model of going into the hood, buying properties, distressed properties in the hood that's already being gentrified, rehabbing them, and then selling them as workforce housing to people in the hood, back to the members in the hood. And it was a social impact model for us to create peer influence. So I did that, for, 2-3 years and led that with the group. And I tapped out of that. And then as an investor, I kind of tapped out of Miami as well, just because everyone knows Miami is like one of the hottest investing markets. So it's hard to really compete if you don't have deep pockets. So I came across these investors in Jacksonville, and they were telling me all, the good stuff that was happening in Jacksonville. So I found me a realtor the next day. I was like, hey, find me a property in this area. So I purchased a historic property in Jacksonville, about 3,000 square feet, 5 bedrooms. And this is an investor, right, who's trying to do a rehab from a distance. And you think you have so much experience, let you do a rehab from a distance. That's going to show you, what type of experience you had. So what was supposed to be a 90-day rehab was a 12-month rehab. That was me suing a contractor, and I beat that one too. Firing a couple of contractors, and then having every single problem that you can think of dealing with contractors, cussing them out, kicking them off my site, wasting money, spending time, the property sitting. So that's what took me to multifamily. After I finally got that done, I converted that property into a bed and breakfast, and it's still operating. So I purchased that property with a lot of equity in it. So it still worked out to be a good deal. But the fact is that I wasted about 9 to about 11 months on that. And the type of burnout that you get from doing a single family project, you might as well put that same energy into multifamily. So that was the transition for me, saying, okay, if I'm going to put in this much tears, have this much sweat going to a single family, I need scale. And I need scale in a major way. It can't be like a 10 unit or a 20 unit. It needs to be 100 units. It needs to be 150 units or better. And that's how I actually tapped into the multifamily sector.
So let's talk to you about the big deal, because most people I've learned aren't able to get that first big deal done. They usually do something in between 5 and 50, and then they step up. So let's talk about that first big deal.
Okay. Well, I'm working on a big deal right now that's also interesting and complex at the same time. So, I already I forecasted what this economy was going to look like going into 2020. I didn't know COVID was going to happen, obviously, and I didn't know it was going to happen this fast and this bad. But I already knew 2020 was going to be an interesting year. So I was looking for a growth market, an emerging market where competition would not be so stiff and where the 5 to 10 year outlook could put me in a really good position. So I went into Detroit. And obviously everyone looks at Detroit like, I don't know about that. You know, we've heard too much. But what was happening in Detroit is happening really fast. And a lot of Black investors are not tapping into it. And so for it to be a Black city, when you talk about gentrification and what that looks like, that's going to be Detroit in 10 years, probably even less than that. And so with all the revitalization that was happening in downtown Detroit, I knew that I wanted to be part of that momentum. So essentially that means that I wasn't too early, but I wasn't late. And that's why I went into Detroit. But I went into Detroit with some prudent wisdom as well. So I got with a couple of developers that essentially I was like, look, take me by the hand. I need to know the ins and outs of Detroit, the good and the bad. And that's essentially what they did. I was like, let me build up my social and political capital. I'm not going to come into a new market and think that, I can run it like how I would normally run it in Miami. And so I purchased a 138 unit building. A lot of things are in Detroit are distressed and vacant. So, I purchased one of those at a very great price. It's been vacant for at least 8 to 10 years, and it was a former senior housing project. So,
what's up, guys? It's your host, Jerome. I just want to let you know we launched Myers Methods in the fall of 2019 with the ambition to inspire a new breed of multifamily investor. If you are interested in getting into multifamily or scaling your current business, hop over to our website at myersmethods.com to grab your free 4-step guide on how to get the ball rolling in multifamily. Now let's get back to the episode.
So my business plan is to redevelop it into an affordable assisted living facility. And that doesn't sound sexy, but if you look at trends and if you see what's happening, the senior sector is probably one of the sexiest sectors that you can get into right now in real estate, because seniors are about to be maybe almost a quarter of the population in less than 10 years. All these boomers are going to be seniors in less than 10 years. And so there's a huge housing gap right now for seniors. And they're calling it the silver tsunami. So essentially, it's going to be a wave of seniors just taking over. They're going to downsize their single family homes, and they're going to move into senior friendly living. And then the oldest of the oldest seniors, those that are like 75 plus, are going to be the ones that are going to be moving into an assisted living facility, because they're not necessarily nursing home ready. And it costs the federal government too much to put seniors into a nursing home. So the assisted living facility is the perfect medium for that. So they need the affordable options. Right now, if you look up senior housing, you're going to find them to be $5,000 to $8,000 a month, because senior housing typically serves the middle to upper incomes. So the affordable segment is what's missing, and then the middle to lower is definitely what's missing. So my building is meeting that gap, and senior housing is not cheap, but what I'm doing is combining HUD vouchers and Medicaid waivers to pay for the housing and the services to secure the operational funds. So I have a pretty solid model. I have a solid operating partner that essentially created this model. So that's why I say it's a complex, even from a financing perspective. I'm pursuing tax-exempt bond financing and LIHTC, low-income housing tax credits for it, and CDFI financing for it. So it's going to be a sweet deal, but it's going to be a long road ahead.
So you just stacked on like all of the things. It's like one of the most complicated deals I've heard of so far. And I admire what you're doing, because there aren't a ton of people who are willing to go into Detroit. They feel like there's too much unknown. And it's kind of like the fog that a lot of people are experiencing with COVID. It's like, what are things going to be like on the backside of this? And is it safe to go there? And how do I know that the play is stable or solid? So talk to me about, like, how'd you pick your operating partner for this? Because, it's one thing to have a business model where you just are providing housing and people are paying you for the opportunity to live in the property. It's something else to have housing and then have the care that goes with assisted living on top of it, which is really profitable if you do it the right way. But how did you find your operating partner so that you could get comfortable combining the two business models?
All right. So going back to your comment about Detroit, I didn't go into Detroit like, oh, I see a $10,000 building. Let me go buy that, which is what a lot of investors do. And they get blown. I spent a lot of time on the ground in Detroit. I walked the streets, I got to know people. I got to know who's doing deals. So I was flying into Detroit every other week, spending 3-4 days at a time. And that's how you do Detroit. You don't do Detroit and find a property online and say, let me go ahead and buy that. So that was the difference in what I did. My operating partner, one of the things for me as an entrepreneur, for one, I don't need to have all the details up front, right? I'm a shrewd entrepreneur and investor. If I have just a piece of a plan together, everything else, I trust the process that everything is going to fall in line. So I saw a building 8 months ago. The footprint is there. What did I say earlier? I wanted scale. So it had 138 units, right? The dollars amount was good. It's an emerging market. I saw how it fit into a bigger economic development picture. So I didn't know that I was going to do an assisted living facility with it. I just knew that it was a senior housing. So if anything, it's a multifamily project. But as you start to vet out your ideas, as you start to, talk to different developers and you start to weigh out your ideas publicly and meet different people, more comes to the table. I didn't intend to pursue life tech or tax exempt bond financing, right? But as you continue to talk to it, I talked to everybody about the project and ideas flourished. And that's how my operating partner came about. I was in Miami speaking to a business colleague and was like, I see this building as a senior housing building. I want to buy it. And she was like, you need to meet the person who created the first senior public housing project in the entire country. I said, oh, hook that up. We had dinner and the rest was history. So I essentially, at dinner, first time meeting this person, I essentially made them a proposition. If I go ahead and buy this building, will you go into business with me? And that's essentially how it came about.
Wow. So you've closed on the building already. How you buy cash, or how do you raise enough cash to buy a building that's a dead asset?
It's my own cash, for one. And secondly, there's a lot of money that's waiting to be invested. So even then, I was raising equity for this deal on the financing side, right? So I knew that when you do any deal, you're going to have to put in 20 to 30% equity anyway, right? So I was already pitching a deal to private equity. And this is the thing, a lot of people in real estate, they want to have all the pieces together before they move on. I saw this property 8 months ago. And even before I actually closed on it, I was already pitching investors. I was already walking in line of me buying this building. So, I was pursuing private equity in it. And you'd be surprised how much money is waiting to be invested. And I actually talked to a few capital markets investors, and they were like, we love the deal, but it's too small for us. You have investors out here, they're not looking to cut a check smaller than $7 million. So the money is available. You just got to talk to everybody. I'm in New York a lot. So while I'm in New York, I'm, meeting up with Wall Street guys, pitching private equity up there. So it's networking. It's talking to everyone. They connect you, and that's how money gets raised.
Were there any missteps along the way with the acquisition of the property, or where you've gotten to at this point on the deal?
No, because I've had more than enough time to digest this. I saw this property in May. I closed on it in March, actually. I had the contract on it in February, closed in March. So there was enough time for me to do all my due diligence, for me to allow it to saturate in my spirit, Even at the moment of closing, I'm like, God, you can really take me out of this deal if you don't think it's going to be good. So I had enough built-in, I would say, checkpoints for me to back out of the deal if I didn't think it was going to be good. So the fact that 8 months and I've stuck through it, it keeps getting better. The picture keeps getting bigger. The players at the table keeps getting larger. And the more and more I vet it, the more people are like, we need this. How do we support this? So I know that I'm right along. Now, that doesn't mean I'm not going to face any roadblocks. Financing for something like this can be anywhere from 6 months to 12 months, So that's going to be the part. So what do you do in the meantime with pre-development? Right. So that's where I am right now, securing pre-development funds, because you still have to do your architectural and engineering. You don't want to wait 12 months and sit on this building that I've already put cash out of pocket. I need my money to start working on me. So it's patient money, but it ain't that patient, So I'm like, I need some pre-development money right now, because it might be 12 months before I can, put shovel on the ground. So that's what I'm working on right now.
Awesome. The last question is, what words of wisdom do you have for our listeners?
Well, it depends on where your listeners are. For those who are starting out, I find that people just don't know where to start and how to start and what to do. And the biggest barrier is fear. People are afraid of losing money, right? And naturally, so nobody wants to lose money, but scared money don't make no money. And I lost money very early, but I made money very early too. So I know what it's like to lose money, and I know what it's like to make it back. And trust me, it's better to lose it and make it back, versus to be so scared to lose it that you never even try in the first place. So it's the fear factor that people have to get rid of. And everybody's appetite is different. Your appetite may not be like, let me go do a 150 unit building, but your appetite is, let me go do a 10 unit. What I can say is scale is important. So in an economy like this, where who knows what type of deals we're going to see, I think we're still waiting to see what that looks like. But you better be ready to go and scale. A lot of people wonder, how do you get the money to do something like this? It's so much easier to raise on a big deal than it is to raise on a small deal. When me and my group started the investment fund, we were doing like $10,000 raises. Do you know how hard it is to raise from $10,000 checks? You know what kind of fear people have when they got to give you their $10,000 savings, and what type of questions and accountability you got to have to those people, versus when you can go raise from someone who says, okay, I can cut you a $3 million check. And all they're looking at are the numbers. The financials is how they make their decision, right? So there's a different caliber of investor that you're talking to when you're raising from a bigger check. So you don't have to deal with the smaller nuances of someone who's giving you their last $10,000. So it's much easier to find that one or two check that can cover your entire raise, versus having to raise $10,000 from 30 people. So the money is a lot easier than what you think.
Awesome. I really appreciate you taking time to share with the listeners. And we'll talk soon. We'll have you back when you get through the process, because I'd love to hear the backside of the deal.
I'm probably not going to get through the process in a long time, because construction is about 15 to 18 months. Pre-development by itself is 6 to 8 months. Financing is going to happen during that same time. That's 6 to 12 months. And then stabilization, once construction is done, is probably another 9 to 12 months, right? So it's going to be a long time. So I'm going to have a lot of different phases, a lot of starts, right? So I'm going to have some new stories probably every few months.
We're going to have you back, because this is exciting. It's a huge deal. Not a whole lot of people are in the space.
Not a whole lot of young people, not a whole lot of women, not a whole lot of Black people are doing senior living or affordable or assisted living, period. So let me just say that.
Standing out, trailblazing.
I want to see more of us, because when I have to go to these equity calls and meetings, and I got to deal with old white men, as the only Black woman, it'll be good to have other people that look like me in the room as well. And now that I'm moving into the senior, I'm far from being a senior, but now I'm moving into the senior business, and obviously I'm probably going to be doing the associations and the national meetings, I'm going to be the youngest person in the room, probably the blackest person in the room. It'll be good to have some other young black people in the room as well. So
All of exposure. Again,
right.
Fabiola, thank you for sharing with the listeners, and we'll talk soon, okay?
Thank you again. Have a good day.
You made it to this juncture, so you really love what we shared on this episode of Myers Methods Presents Multifamily Missteps. Do us a favor, give us a 5-star rating, give us a review, and share this with somebody who's interested in multifamily investing. Until the next time, the pack is with you.